Behind the flux and reflux, the continuity and change that mark the life and progress of a nation is the virtual presence of the concept of value, familiar to us in everyday life as money. And harnessing, regulating the flow of money, keeping the economy on an even keel, is the Central Banking Authority of India. To us, the Reserve Bank of India.
Developing economies are mostly characterized by a large rural sector and heavy dependence on agriculture, high incidence of poverty, and inadequate infrastructure. These conditions and the goals of national development naturally influence the functioning of central banks in developing countries. Beside their traditional role, they undertake promotional functions to widen and deepen the financial infrastructure, promote financial savings, and ensure availability of credit for the growing needs of the economy, including those of the weaker sections of society. Progress in India in this regard has indeed been remarkable.
The Reserve Bank of India was established in Calcutta on the 1st of April 1935 in accordance with the Reserve Bank of India Act 1934. To begin with, it was a shareholders' bank and entered upon its career as a state-owned institution from the 1st of January 1949. As the preamble to the Reserve Bank of India Act puts it, the bank was set up with the objective of regulating the issue of bank notes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage. Initially, its headquarters was in Calcutta. The headquarters was shifted to Bombay in 1937. The traditional functions of the Reserve Bank of India are the same as those of any other central bank, namely to act as a sole note-issuing authority, banker to government and banker to banks. However, in discharging these functions, the bank has been consistently and growingly sensitive to India's developmental priorities. Accelerating the flow of credit to the rural sector has been one of the most important functions of the Reserve Bank from the beginning. The bank is also responsible for administration of exchange control, exchange rate management, and management of the foreign exchange balances of the country. Sir Osborne Smith, an Australian banker, was the first governor of the Reserve Bank of India. Sir C.D. Deshmukh, who later became the Union Finance Minister, had the distinction of being appointed the first Indian governor of the bank in 1943. With the advent of freedom and the nation embarking upon developmental plans, the concept, outlook and responsibilities of the Reserve Bank of India too underwent a change. The bank has its offices in most of the states of the country except in the newly created states in the northeastern region. The office at Guwahati in Assam takes care of all the states in the northeastern region. Each Reserve Bank building, wherever it be, has an architectural distinctiveness that sets it apart as a landmark in that region. while the old head office in Bombay, constructed in the classic European tradition, stands as an archetypal testimony to banking history in India, just across the road is the new central office building, imposing and elegant, conveying a sense of the new and diversified functioning of the Central Banking Authority of India. The central office at Bombay is responsible for supervision, control and direction of the work of the regional offices and branches. The central office also maintains regular liaison with the Government of India. Under the Reserve Bank of India Act, the power of general superintendence and direction of the business and affairs of the bank are vested in the Central Board of Directors, comprising 20 members and headed by the Governor. The day-to-day business of the bank is, however, conducted under the overall supervision and direction of the Governor, who is assisted by Deputy Governors. A committee of the Central Board, constituted in the bank's central office at Bombay, takes decisions on important financial and administrative matters. The Governor and the Deputy Governors, whose number cannot exceed 4 under the Reserve Bank of India Act, are appointed by the Government of India on a full-time basis. The remaining 15 directors are also nominated by the Government of India to represent different economic as well as territorial interests. These directors include a government official, generally the Finance Secretary, who is nominated by the central government. The Governor and Deputy Governors are assisted by executive directors in the day-to-day administration. In addition to the Central Board, the bank also has 4 local boards for the eastern, western, northern and southern states, with headquarters at Calcutta, Bombay, New Delhi and Madras respectively. The members of the local boards are nominated by the Government of India to represent different interests. Unlike the Central Board, the role of the local boards is largely advisory in nature. From the ancient system of barter, through coins of different metals with intrinsic value, to the modern currency note made pervasive with the advent of the printing press, the growing sophistication over the years of the term of a transaction of exchange provided the rationale for the Reserve Bank of India's role as sole note-issuing authority. This authority emanates from the Reserve Bank of India Act, which permits the bank to issue bank notes in the denominations of rupees 2, 5, 10, 20, 50, 100, 500, 1,000, 5,000 and 10,000, or such other denominations not exceeding 10,000 rupees as the Government of India may specify, on the recommendation of the Reserve Bank. At present, notes of the denominations of 1,000, 5,000 and 10,000 rupees are not issued. Apart from the notes of various denominations issued by the bank, the Government of India also issues notes of the denomination of rupee 1 through the bank under the Currency Ordinance of 1940. Technically, the rupee 1 note is called the rupee coin. The responsibility of distributing the rupee 1 coin and smaller coins of the denomination of 50 paise and below issued by the Government of India under the Coinage Act of 1906 is also vested in the Reserve Bank. Minting of coins is done at 4 mints: Calcutta, Bombay, Hyderabad and Noida near Delhi. Banknotes as well as rupee 1 notes are printed at the currency note presses at Nasik Road in Maharashtra and Devas in Madhya Pradesh. Two more printing presses are being set up to meet the increasing demand for new notes. The 2 currency note presses in 4 mints are owned and run by the Government of India. The Reserve Bank's responsibility is not only to put currency into or withdraw it from circulation, but also to exchange notes and coins into such other denominations of notes or coins as may be required by the public. All transactions relating to the issue and exchange of notes are conducted through a separate department of the bank known as the Issue Department. Collection of revenue and payment on behalf of the government are conducted through the Banking Department. Under the Reserve Bank of India Act, the assets and liabilities of the Issue Department and those of the Banking Department have to be kept separately. The Issue Department is liable for the aggregate value of bank notes in circulation and maintains eligible assets equal to this liability at all times. Important among eligible assets of the Issue Department are assets like gold, rupee 1 coin, foreign securities and rupee securities issued by the government. By the middle of 1990, there were 15 full-fledged offices and 2 sub-offices of the Issue Department at important centres in the country. Banknotes and rupee 1 notes are also put into circulation through currency chests spread over the whole country. Currency chests are maintained by the Reserve Bank with agency banks, which include State Bank of India and its 7 subsidiaries, other public sector banks, and also treasuries and sub-treasuries of the state governments. Apart from facilitating circulation of currency throughout the country, these currency chests provide ready funds to agency banks and government treasuries for conducting government business. Surplus notes received daily in payment towards government dues are also deposited in the currency chests. There were, at the beginning of 1990, over 3,700 currency chests spread over the whole country. Distribution of small coins of the denomination of 50 paise and below is arranged by the Reserve Bank of India on behalf of the central government through small coin depots, which are counterparts of currency chests. Reserve Bank has a responsibility of feeding currency chests with fresh notes and removing at periodic intervals the soiled notes accumulated at the chests. Many are the trials and tribulations of currency notes in circulation. Indifferent and callous handling, more than natural wear and tear, lead to the problem of soiled and mutilated notes unfit for continued circulation. Under the law, Reserve Bank is not bound to exchange mutilated or defective notes, but it does so as a measure of grace. Apart from exchange of defective notes through the bank's own issue department, this facility is also available to the public through branches of commercial banks maintaining currency chests. Notes unfit for further circulation are sorted out counted, bundled, punched and destroyed by incineration at the Reserve Bank offices. The main function of the Reserve Bank of India as banker to government is to arrange for collections of revenue and for various types of payments on behalf of the government. In respect of the central government, this is a statutory responsibility of the bank, whereas in the case of state governments, this is done on the basis of agreements signed by them with the bank. At the Reserve Bank offices, this function is conducted through the Public Accounts Department. But the Reserve Bank has also made arrangements with agency banks like the State Bank of India, its 7 subsidiaries, and several public sector banks for discharging this important function. The Reserve Bank of India does not charge any fees for conducting government's banking business. In return, the central and state governments keep their balances with the Reserve Bank, for which no interest is payable to them. The Reserve Bank also manages the public debt of the central as well as the state governments through the public debt offices. Advice on policy matters like the timing of flotation of new loans, size of loan, coupon rate, etc. is tendered by the bank through the central office. The Reserve Bank also provides temporary financial accommodation to both the central government and the state governments. In the case of the central government, this takes the form of ad hoc treasury bills of 91 days maturity which are sold to the Reserve Bank. The state government can get temporary accommodation in the form of ways and means advances. The principal accounts of all governments are maintained at one place, namely the Central Accounts Section in the bank's office at Nagpur. All transactions conducted daily through the bank's own public accounts departments and agency banks branches handling government business are reflected at the end of the day in the principal accounts maintained with the Central Accounts Section. The creation of ad hoc treasury bills on behalf of the central government and final settlement of transactions relating to the Reserve Bank Remittance Facilities Scheme are 2 other important functions performed by the Central Accounts Section. The Remittance Facilities Scheme is designed to facilitate swift and economical transfer of funds between different centres throughout the country. The Reserve Bank also functions as banker to all other banks in the country, and lender of the last resort to the accounts department maintains current accounts of scheduled banks and grants loans in advance against securities. Banks are required to maintain minimum cash reserve at the prescribed rates in their principal current accounts with the Deposit Accounts Department. For the smooth conduct of trade and commerce, it is essential to provide quick check clearing facility at all important commercial centres. This is done through clearing houses. At centres where the Reserve Bank has its banking department, the clearing houses are run by it. At other centres, they are generally conducted through the State Bank of India or its subsidiaries. At the 4 metropolitan centres of Bombay, New Delhi, Calcutta and Madras, the clearing of local as well as intercity cheques has been fully computerised and is handled by the national clearing centres. All cheques and other payment instruments to be cleared through the national clearing centres have to be printed on special type of paper with special ink to facilitate their mechanical sorting with the help of magnetic ink character reading machines before further processing on the computer. These modern facilities have greatly improved the speed of cheque clearance and enabled the Reserve Bank to hand efficiently the fast-growing number of payment instruments. The Reserve Bank is called upon to tender advice to the central government regularly on important policy matters. It has also to maintain regular liaison with international agencies like the International Monetary Fund and World Bank.
Regulating the overall volume of money and credit is an important function of the Reserve Bank. In performing this function, monetary policy has 2 important objectives in mind. One is the promotion of economic growth, and the other is the maintenance of a reasonable degree of price stability. In the recent period, the objective of price stability has assumed greater importance than in the past. Monetary stability is, however, an expression that finds its place in the preamble to the Reserve Bank of India Act. Money is a liability of the banking system. Money can therefore expand only if the assets of the banking system, namely credit to the various sectors, expand. In this process, credit provided by the Reserve Bank of India to the central government assumes a critical role, as this forms the base for further monetary and credit expansion. In the Indian context, a high degree of coordination between the government and the Reserve Bank is necessary if the growth in money supply is to be kept within limits justified by the expansion in real output and an acceptable degree of price increase. Budget deficits and monetary expansion are closely linked to each other, and the one cannot be contained without containing the other.
For the formulation of monetary and credit policies and monitoring and analysing the emerging trends in the financial as well as real sectors of the Indian economy, the Reserve Bank maintains a separate department called Department of Economic Analysis and Policy, which is staffed by professional economists. Another department, called Department of Statistical Analysis and Computer Services, is responsible for collection and processing of statistical data and information. These 2 departments are responsible for providing analytical tools for policy formulation. An important task performed by them is compilation of basic banking statistics and preparation of the country's balance of payments. They also undertake several special studies. These 2 departments are also responsible for the preparation and publication of some of the important banking and financial reports, the most prestigious of them being the annual report on trend and progress of banking and the report on currency and finance. One of the essential functions of the Reserve Bank of India is to maintain the external value of the Indian rupee. External stability is closely related to the internal stability and the internal economic strength of the country. The external value of the Indian rupee is determined with reference to the daily exchange rate movements of currencies of India's major trading partners. Apart from fixing the rates of exchange for the rupee, the Reserve Bank sells pound sterling and US dollars to banks authorized to deal in foreign exchange and purchases pound sterling, US dollars, Japanese yen and West German marks from them. Reserve Bank is also responsible for prudent management of the country's foreign exchange reserves. Foreign payment and receipts on behalf of the Government of India are also handled by the bank. All this calls for on-time world-linked information service and direct communication facilities with all important financial centers in the world. These functions are handled through a separate department called Department of External Investments and Operations. Administration of exchange control is also a very important function of the Reserve Bank. The need for exchange control arises because the demand for foreign exchange is much greater than its total supply, and it becomes necessary to ration the supply of this scarce resource to individual applicants so as to put it to the best possible use for the country's economic development. The statutory basis for administration of exchange control is provided by the Foreign Exchange Act 1973. All payments and receipts in foreign exchange are required to be routed through banks authorized by Reserve Bank to deal in foreign exchange. Additionally, Reserve Bank has granted licenses to a large number of shops and establishments throughout the country to receive from foreign visitors payment in foreign currency like notes, coins and travelers' checks for goods sold to them or services rendered to them. Exchange control is complementary to trade control, which is directly administered by the Government of India through the Chief Controller of Imports and Exports. Apart from regulating all trade payments, that is payments for imports and receipts for exports, Reserve Bank also regulates foreign investments in India, Indian investments abroad, foreign travel and payments for services. Since the advent of the 80s, considerable emphasis is being placed on investment facilities in India for non-resident Indians. Basic data relating to import and export transactions and payment towards services which go into the country's balance of payments position is also compiled in the Exchange Control Department before it is processed on the computer. India being a predominantly agricultural country, from the very beginning, Reserve Bank began developing institutions for providing credit in the rural areas. Before independence, almost the entire finance required by the farmers was provided by money lenders who charged exorbitant rates of interest apart from following other exploitative practices. After independence, the need for translating the content of political freedom into meaningful economic independence and well-being of the people was at the core of the Reserve Bank's planning for banking development in the country. As part of this strategy, Reserve Bank took initiative in developing and strengthening a three-tier cooperative credit structure. That is, state cooperative banks, district central cooperative banks, and village-level primary agricultural credit societies for providing short-term loans for production and marketing activities of farmers, as well as handloom weavers and other cottage and small-scale industries. These cooperative institutions were also encouraged to mobilize deposits from the rural areas. Reserve Bank of India provided increasing refinance to state cooperative banks at a concessional rate of interest. Similarly, Reserve Bank helped in developing land development banks for providing long-term loans to farmers for investment in land development, wells and pump sets, etc., and for allied activities like dairy, poultry, fishery, and so on.
In a developing country like India, the central bank had a special responsibility to develop a sound and adequate banking system to cater to the needs of agriculture, industry, trade, and commerce. The first major step in this direction was the Indonesian of Austral Imperial Bank into State Bank of India. The 60s witnessed a period of consolidation of the banking system, and a large number of weak banks were weeded out through a process of mergers and amalgamation. The next significant development was the introduction of social control in 1968. However, a major impetus to the banking development was provided by nationalizations of 14 major banks in 69, followed by nationalization of 6 more banks in 80.
After the nationalization of major commercial banks in 1969, Reserve Bank encouraged the banks to open more and more branches in rural and semi-urban areas for providing loans to farmers and village artisans in order to increase their production and income. In 1976, a new type of bank called regional rural banks were created to meet the special credit needs of the rural sector. By the end of June 1989, the total number of bank branches had risen to over 57,000 from just 8,262 in June 1969. During this period, the share of rural branches rose from 22% to 57%, and the average population served per branch came down from 65,000 to 12,000. Bank deposits grew from just 4,646 crores to 1,47,000 crores. In 1963, Reserve Bank set up a specialized agency, the Agricultural Refinance Corporation, for providing medium-term and long-term loans for development of agriculture. Subsequently, this agency was renamed Agriculture Refinance and Development Corporation. This was followed by the establishment of the National Bank for Agriculture and Rural Development in 1982 as the apex institution for providing credit for agriculture and rural development. Reserve Bank transferred the National Rural Credit Long-Term Operations Fund and the National Rural Credit Stabilization Fund to the new bank. The Reserve Bank of India contributes every year to these funds out of its own profits. Reserve Bank of India's Rural Planning and Credit Department, which oversees the rural credit system in the country, also ensures that banks give loans to priority sectors which include agriculture, cottage and village industries, small-scale industries, small business, and schemes for self-employment and poverty alleviation as stipulated from time to time as national policy. A new strategy for rural development, known as Service Area Approach, has been introduced by the bank from the 1st of April 1989. The purpose of the scheme is to develop a more effective and faster credit delivery system in the rural area. Under the scheme, 15 to 25 villages are assigned to each rural and semi-urban branch of a commercial bank so that every village is covered under a plan for supply of credit. After carrying out village surveys for assessing the potential for lending for different activities, the bank managers have to prepare a branch credit plan every year. Coordination between the banks and government agencies for the effective implementation of the credit plan is done through a block-level bankers committee. At the fountainhead of the banking system, the Reserve Bank has statutory powers of control and supervision over commercial and cooperative banks. These powers include licensing new branches, issuing directives and guidelines from time to time, obtaining returns and statements, and, more importantly, periodic inspections. The statutory powers for supervision and control over commercial as well as cooperative banks are derived by the Reserve Bank from the Banking Regulation Act 1949, apart from the powers vested in it under the Reserve Bank of India Act 1934. The Department of Banking Operations and Development is responsible for these functions. Branch inspection is a powerful and effective instrument of supervision over banks and is supplemented by high-level action plan reviews at regular intervals. A unique and successful experiment in our country has been the establishment by Reserve Bank of India of subsidiary institutions for undertaking various specialized functions in the area of agriculture and industrial finance. Some of these institutions were later allowed to separate themselves from the bank and become autonomous entities. Notable among these institutions are NABARD, or the National Bank for Agriculture and Rural Development, IDBI, Industrial Development Bank of India, UTI, Unit Trust of India, DFHI, the Discount and Finance House of India Limited, NHB, the National Housing Bank, and the DICGCI, Deposit Insurance and Credit Guarantee Corporation of India. While NABARD takes care of rural development, the IDBI and UTI lend support to industrial development. The IDBI and UTI became autonomous corporations in 1976. The DFHI was established in 1988 jointly by the Reserve Bank of India, public sector banks and financial institutions for smoothening the short-term liquidity imbalances in the money market. Developing an active bill market is an important objective of the DFHI. Providing shelter to the growing millions in our country has been a pressing priority. To provide finance for this purpose and to accelerate housing activity, it was decided to set up a separate apex financing agency. Thus, the Reserve Bank established the National Housing Bank in July 1988 as a fully owned subsidiary. The National Housing Bank aims at promoting savings among the people for acquisition of dwelling houses by them. A fishery unit running at a loss, a small industrial unit turning sick, and natural calamities like drought and floods. To meet such exigencies, Deposit Insurance and Credit Guarantee Corporation of India, DICGCI, was set up in 1961 as a wholly owned subsidiary of the Reserve Bank of India. Besides guaranteeing the banks against possible losses on advances to the weaker sections and the priority sectors, DICGCI also provides explicit safeguards that builds the confidence of depositors and encourages the banking habit. Apart from developing various financial institutions, Reserve Bank of India also ensures that the personnel who manage commercial banks and other banks are given appropriate training. It took the initiative in starting training colleges for this purpose. These training institutions are rated high, not only in India, but in other developing countries too, and therefore attract a good number of foreign participants. The Bankers Training College, BTC, at Bombay was set up in 1954 by the Reserve Bank of India. The college was the first conscious effort to provide systematic training for bank personnel in the country. Every year, about 2,300 officers are imparted training in various areas by the college. In keeping with the Reserve Bank of India's role as developer of proper rural credit delivery system, the College of Agricultural Banking was established at Pune in 1969. It is an apex level institution in the country for orientation and training in rural banking. International organizations like the World Bank, FAO, etc. have conducted several training programs jointly with the college. It runs programs in 5 channels and trains about 2,300 officers every year. To meet the specific training needs of its own personnel in the junior and middle level officer cadres, the bank established the Reserve Bank Staff College at Madras in 1963. Apart from induction level and broad spectrum general development programs, the college conducts specialized functional programs to improve the operational skills of the officer staff. Computers are widely used in various programs. In 5 channels, the college trains about 1,700 officers every year. Reserve Bank also runs 4 zonal training centers at Bombay, Calcutta, Madras and New Delhi. The zonal training centers mainly cater to the needs of training the bank's clerical staff. However, a few programs are conducted every year for the benefit of the subordinate staff as well. The National Institute of Bank Management, Pune, was established in 1969 as an autonomous institute and is supported by the Reserve Bank of India along with other national-level financial institutions and commercial banks. The institute anticipates national needs and aspirations, discerns likely directions of change, and helps the banks adapt to the emerging demands. As part of the commemoration of its Golden Jubilee, the Reserve Bank of India set up in 1987 the Indira Gandhi Institute of Development Research, an advanced research institute at Bombay for the study of issues relating to economic development in order to promote the study of and conduct research on development from a broad interdisciplinary perspective: economic, technological, social, political, and ecological. Keeping pace with the newer demands made of the banking system to keep it abreast of and ever responsive to a society in rapid transition, automation is the catchword of the day.
Administration of monetary policy in a developing country like India is a complex task. Considering the strong and persistent pressures in the economy, it has been possible to contain inflation within limits. The Reserve Bank is confident that it will continue to discharge its onerous responsibilities effectively and thus help to sustain economic growth with stability and social justice.
At the same time, keeping a finger on the pulse of India, which essentially keeps time to the rhythm of her villages, the Reserve Bank of India takes on a stolid and enduring role. As the repository of the faith and trust of the generations of a nation. Rising to meet the rising expectations of a people from the bedrock of stability, tradition and experience. Keeping vigil over a dynamic economy. The Reserve Bank of India.